This week on Wealth Track, a self-described authority-resistant troublemaker takes us on a ride where others fear to tread. Tocqueville Fund's great investor, Robert Kleinschmidt, hits the road to find the best values in contrarian ideas with limited downside risk. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of the most famous financial magazine covers late in the last century was The Death of Equities: How Inflation is Destroying the Stock Market. It was published by Businessweek in 1979 when it seemed as if the entire investing public had had it with stocks after a very rough multi-year stretch. Well, fast forward to today, and a similar but not quite as definitive headline was put on the front page of the Financial Times. The Death of Equities, ? Investors shun shares. As the FT said, institutional investors from pension funds to mutual funds sold directly to the public have slashed holdings in the past decade. Stocks have not been so far out of favor for half a century. Many declare the cult of the equity dead. Now, the question any seasoned investor would logically ask is, do pronouncements like these signal the exact opposite, that in fact equities are about to seriously turn after their dismal decade? As Wealth Track guest Jason Trennert reminded clients in a recent report, the great bull market of the 1980s started 3 years almost to the day after the famed Businessweek cover of 1979. Now, in retrospect, 3 years seems like a brief and bearable interlude. But for investors having already lived through a prolonged bear market, it was a very painful period. Investors today are suffering from their own form of post-traumatic stress syndrome, having endured the so-called lost decade of the 2000s, which saw 2 market crashes and the most serious financial crisis in recent memory, a crisis which is still in full swing in Europe with no end in sight. And investors continue to be whipsawed by the markets as they switch from risk-on to risk-off trades, depending upon the headlines. So is it any wonder that professional and amateur investors alike have fled the volatility and riskiness of stocks for the apparent security and income of bonds? Well, not so today's guest, a self-described authority-resistant troublemaker who prides himself on keeping his clients out of trouble through his firm's contrarian value approach. He is Robert Kleinschmidt, who appears exclusively on Wealth Track. Robert is the CEO, President, and Chief Investment Officer of Tocqueville Asset Management, where he oversees more than $11 billion worth of investments. Tocqueville is a sponsor of Wealth Track, but Kleinschmidt is here on his own merit as a great investor. The Tocqueville Fund, which he has managed for 2 decades, has beaten the market and its category over the long term. I began the interview by asking Kleinschmidt for his single most contrarian investment idea.
Well, I think the single most contrarian position you can take right now is to be bullish. There's a million reasons to be bearish, and they're all valid. But most of them, I think, are pretty much old hat or well known. I mean, how many times do we actually have to discount Greece, or Greece leaving the euro, or how many times do we have to discount banking problems in Europe? These are not unknown problems, and so I think to some extent the negative scenario, it's a big one, which we've talked about in previous programs about the sort of, in my view, the decline of the Western welfare state and the transition period that we're in, and the eventual default of sovereign debt and the likely inflation that's coming as a result of the massive entitlement programs. I think those are all still there, and I think those are all still problems particularly for fixed income securities. But on the other hand, I think that there are some important events that could occur over the course of the next several months or so that could have a profoundly important impact on the way people change their thinking about these sorts of things. And so, to some extent, I think these are the problems that face the stocks and the problems that face the markets are more political problems than they are economic problems. So, I mean, we can talk about how stocks are relatively cheap. They're on a PE basis. They're cheap on a historical basis.
So how cheap are stocks?
Well, I think they're undervalued. You know, cheap is, they're not selling at 8 times earnings like they were in 1982, before the beginning of the great bull market. But, at 12 and 13 times earnings, they're well below the post-war average of, say, maybe 16 times earnings. So corporate balance sheets are in terrific shape. That's something that is, not always the case. It's clear to me that with good news or a change of perspectives, there's enough value there for the market to do better. And what has to happen in order I can't predict what events will occur that could change the attitude. But I'm saying that the surprises are much more likely to be, or there's more upside to upside surprises than there is downside to downside surprises, because the sorry state that we find ourselves in is well advertised and well known, and it's been going on for a number of years.
So what are some of the things that you think could be significant kind of game changers that could happen on the upside?
I think that if there was an indication in the electoral process that's coming up in November, that there was a willingness on the part of the public to actually deal with problems that nobody really wants to deal with because they're difficult.
Such as?
Well, certainly the fiscal cliff, certainly the entitlement program, certainly the situation with government employee pension and health care and all those kinds of things where, what you learn is nobody likes to take things away from people, and nobody willingly wants to give these things up. But things that are unsustainable will not be sustained, and these things are unaffordable, and there's just not enough money to fund all of these things. And so there's going to have to be, sooner or later, an opportunity to scale these things back. If in the political process we can do this without having people riot in the streets, that's a very positive thing. But what you see is that in places like Greece and elsewhere, England and France, when you've had cutbacks, people do take to the barricades. They do riot in the streets. So it's a very tough, difficult political environment to get things done. Nonetheless, all of that's fairly well known. All of this has been out there. And if there's some progress on this in the United States, I think that will make people feel better about the market.
So let's talk about just stocks as an asset class in general. This is your professional career, but institutional and individual investors have withdrawn kind of wholesale from stocks. Right. They are flocking to corporate bonds, as you know. They're flocking to alternative investments. So 50% declines in the last decade. There are reasons that people are afraid of stocks. So why don't you consider stocks to be high risk? And given all of the other things that you just mentioned that are affecting the markets on any given day.
Well, some stocks are high risk, and those stocks that have a lot of expectations built into them tend to be higher risk than the others. Facebook, Facebook had a lot of expectations built into it. But to the kind of names that I like to buy, where there's plenty of cash on the balance sheet, there's no debt, the stocks are trading at 8, 9, 10 times earnings, they're very high returns on capital, returns on equity, free cash flow. Those numbers are there, you can see them, and I don't see a lot of risk in that. They may not make you any money, but they're not a guaranteed loser like a long-term bond is, because sooner or later when inflation comes around and rates begin to crawl up, these bonds that you're buying today that are yielding 1.5% are going to go down to 50 cents on the dollar or lower. That's not going to happen with the kind of stocks that I think that we try to own in the Tocqueville Fund.
And let's talk about the kind of stocks that you try to own in the Tocqueville Fund. So the way that you de-risk your portfolio in a market that you still think is going to be pretty volatile, and also where the correlation among different assets is going to be pretty high. So what's your approach so that you first of all, you don't lose your clients' money, and second of all, you make your clients' money?
Well, obviously the first part is to try not to lose it.
Right. Priority number one.
Yeah, that's priority number one. And what you try to do there, or what I try to do there, is buy companies where the metrics, the financial metrics, are very attractive. And to some extent, I mean, I'm interested in the future, and we make estimates of where things are going. But I'm really looking at what, is this a value right now on the basis of the current revenues, on the current earnings, current cash flows, current returns. And there are whole classes of stocks where that's true. We talked a little bit about the technology area. I mean, the large technology stocks, I mean, I'm no technology analyst. And when I read technology reports, my eyes glaze over after I get past the executive summary. So it's tough. It's tough to know what's going on. But what I do know is I can look at market share. That's not so hard to figure out. I can look at returns on capital. That's not so hard. I can look at free cash flow. That's not so hard. And on the metrics that are important to me, these companies are very cheap. On top of which, they're world class. They have
companies such as
Microsoft, EMC, Google,
Cisco.
Well, Cisco's a good example. I mean, more than 33% of Cisco's market value is in cash. So I mean, now I wish these technology companies would return cash to the shareholders. I think they should return cash to the shareholders. However, I'm resigned to the fact that they're probably not going to return it as much as I would like. But they've got a lot of cash, and it does represent an anchor to windward or ballast against downdrafts in the market. And they might eventually do something wise with their cash, in which case you'd get some value out of it. You're not getting any interest income out of it at this stage of the game. They do buy back stock from time to time, but for the most part, that just anesthetizes their stock option program. So I'm not quite as keen on stock repurchases as I once was. Some of them have instituted dividend programs, and I think that's important. But really, what these companies should do are pay big liquidating dividends or semi-liquidating dividends to their shareholders. They're not going to do that. So what might they do? Well, a lot of them have spent money on acquisitions. Most of these acquisitions I don't think have worked out. That's the nature of acquisitions. So I don't think that they should be frittering away money in that. A lot of the cash they have is overseas, so they can't bring it back. One of the thoughts that I've been developing is that if a technology company, or any company that matter, but a U.S. company that has built up a big cash position overseas and can't bring it back, because even though they paid taxes overseas, the U.S. government wants you to pay more taxes when you bring it back, I'm beginning to think some of these companies should move to where their cash is. I mean, instead of bringing
anyone listening to you in the corporate suite?
Yeah, instead of trying to bring the cash back to the United States, if they're making all this cash elsewhere, and if the United States is unfriendly to them from a tax point of view, then maybe they should move over. That would be good for their shareholders. So these are all. I know it's a controversial point of view, but still, something has to be done to surface the value of all the cash they're building up. And why are they building up so much cash?
Right.
Because they've got very good businesses. They have very cash-generative businesses. And for the most part, they cannot reinvest enough money in their own business to deploy all this cash or to prevent the cash from increasing. So that's a high-class problem, and I'd rather own companies that have that high-class problem, even if I'm not wild about what they're doing with the cash, because I think sooner or later that cash gets translated into value.
Apple, you told me you haven't owned it yet.
Right.
What are you waiting for?
Well, I want to be the last one to buy it. No, we did take a close, and we do own it in some of our funds, but in the fund that I run, we don't.
Tocqueville Fund.
Tocqueville Fund, we don't own it. But we did take a good close look at it about a week ago when it got to around $530, because it was down over $100 a share. And there are a tremendous number of metrics that suggest that Apple is attractive. And so I couldn't resist at least getting close. And of course, not long after we looked at it, it shot back up again, so that made it easier for me to say I'll wait. But what really bothers me about Apple is that it's hard for me to see how things get better for Apple. It seems like they're hitting on every single cylinder. And they are very widely owned, and so that's bothersome as well. And it's hardly contrarian in that everybody thinks it's terrific. So I think there's probably risk there if all of a sudden the next product isn't the next Apple iPhone or iPad or this. So that's one thing. And then the other thing is that the competitive world isn't crazy. They've seen what Apple has done, and they've seen the margins so everybody's shooting at them. Google's shooting at them with Android, and in the paper the other day, Facebook is thinking of creating an iPhone. So they're a target. There's a big target on their back. So I think that Apple probably will be all right, and I'll probably be lamenting the fact that I didn't buy it. But in order for me to buy it, I need to see a disappointment. I need to see some of the air come out. Not that there's that much air in it, because it isn't overpriced on most metrics, but they've been on such a winning streak, and I hate to buy companies that have been on such a winning streak. I'd rather buy one that has had a couple of stumbles and get on the next winning streak. So that's my take on Apple.
Okay. You mentioned earlier that you like it when companies stumble, and so are there any companies that have stumbled particularly egregiously recently that have come up on your screen?
Well, Chesapeake. That might be too big of a stumble. Chesapeake Energy, that might be too big of a stumble. But that's an example of a company that's really has stumbled, and but has a great deal of asset value underneath it. And their problem is that they really don't have the cash to develop what they have, and they've got some overhanging debt. So it's a gamey situation.
Do you own it?
I own it, and I'm convinced that it needs to be taken over. I think that it would be an excellent acquisition candidate for any cash-rich company, particularly a big cash-rich energy producer, but even if you weren't, because the assets are there. They're the second largest producer of natural gas in the United States, which is a pretty big market, and what they really need is more money to develop the prospects that they have. So that's an example of, that's a somewhat gamier stock than what I'd normally like to own, but the asset value is pretty compelling.
Which leads me to the larger topic, which is natural gas. Again, a contrarian play, if there ever was one, and that's an area that you're looking.
I'm very interested in that. As a matter of fact, we're thinking about starting a natural gas fund, sort of along the lines of the gold fund that we started in the 90s, because to me, natural gas is a really big deal. I think that what it represents is possibly a return to the cheap energy era that existed before 1973 in this country, in the Yom Kippur War and the quadrupling of oil prices and all the rest, for those of you who can remember that. And I do. So with natural gas prices at $2, $2.50 an MCF, even at $3 an MCF, that's the equivalent of $18 oil, or maybe $24 oil. But at any rate, it's the equivalent of very cheap oil. And not only is it cheap, but it is abundant. It's abundant like nobody ever dreamed that it would be abundant. And so that could be a game changer. And in fact, I think it could be the offset to all of these government manufactured problems that we talked about earlier, the sovereign debt problems and the entitlement problems and the unaffordability problems. While all of those are real, this is a real bullish underpinning for the U.S. economy.
So one area where you might be part of the consensus view is in your view of financials, which the view is fairly negative.
Right.
You actually think that the financials are in for a long-term
certainly
secular decline?
Yeah, certainly the large financials. I mean, the big banks, in my view, are no longer purely commercial enterprises. And they're not maybe even partially commercial enterprises. They're really arms of the political apparatus. I mean, you got the regulators telling them what they can pay people, where they can put their money, how they can invest. I mean, so it's not easy for a stock guy to understand companies that are not really operating by the same kind of profit incentives that everyone else is. So the really big companies, they'll go up, they'll go down, there'll be trades in them, and smarter people than I will be able to figure out how to do that. But when you buy these things as businesses rather than as pieces of paper, you can't really make a business case for a quasi-government institution. It just, it's a contradiction of terms.
What about the death of equities theory? And that we are now seeing again. We saw it at Business Week in 1979. We've just seen it in the FT recently, and the fact, again, that institutions and individuals have withdrawn from equities and that they're investing in, just about any other asset class.
Well,
and the love affair of the FT, basically the cult of equities is over.
I think
what the
that's
FT is
true.
saying.
I think the cult of equities is over, and I think it's, that's good. I think that's a good thing. I don't think we're anywhere near the death of equities, because these stocks are going to be owned. There's a terrible adage. I love Wall Street adages, but there's a terrible adage that says in bear markets, stocks return to their rightful owners, which is one of my favorites, even though it seems. But the point is that there were a lot of people who were involved in the stock market who shouldn't have been there, who didn't have the capacity to take the risk that's associated with stocks, and they're probably better off outside of stocks, although there's no returns anywhere else at the moment, but at least they're not exposed to the volatility and the risk. But all that being said, stocks strike me as being a hell of a lot better than bonds at this stage of the game. And as far as alternative investments are concerned, I mean, that's sort of in my judgment, in many cases, the name without meaning. It's just an alternative way of charging clients for owning the same stocks or the same bonds that you own, and generally speaking, a more expensive way of doing it. So, you can own real assets, you can own financial assets, and in the financial assets, you can own fixed incomes or equities or some hybrids of that. That's it. I mean, there's nothing more complicated about it than that. And the fixed income assets are the ones that are most exposed to an inflationary period that we're going to have, and they're most exposed as well to higher interest rates, which we're going to have. I just can't tell you when. And I'm sure that the people in Spain who a year ago were paying 200 basis points for their debt and are now paying 700 basis points for the debt didn't know how fast it was going to happen, and wouldn't have predicted that it was going to happen over the course of the next 12 months. And we won't be able to predict when it's going to happen to us, but it will happen, because you've got to induce people to own your debt when they think that what they're going to get paid back with is going to be worth less than what they gave you.
But to your point about that the people who own stocks that shouldn't have basically, they've left their hands because the stocks were too risky to begin with. So the premise has been that stocks have been the growth asset,
right,
and that they have a core position in everyone's portfolio, that they are a core investment for retiring portfolios. I mean, was that a mistake?
No, I don't think that is a mistake. It's a question of degree, and it's the question of the kind of stocks that you own. I mean, you can own conservative, well-capitalized, dividend-paying stocks. The pharmaceutical stocks right now, some of the technology stocks that we talked about, the consumer staple stocks like
such
Johnson & Johnson, Campbell's Pork and Beans, Procter & Gamble, these are all pretty cheap. You can own those stocks. Now, they may go up and they may go down, but they're not likely to collapse as a result of the fact that they weren't underpinned by valuation parameters that supported the price in the first place. I once wrote, remember the television program, Who Wants to Be a Millionaire? Mm-hmm. I once wrote a piece called Who Wants to Stay a Millionaire? And the idea was that the stock market is not a good place to become a millionaire, and it isn't. But it's a very good place to stay a millionaire if you follow certain disciplines and stick with them. And I think the problem is that for a great many people, they got enthusiastic and it became a casino for them. And once it becomes a casino, then it's not an appropriate place for your 401k or for your IRA or for your retirement funds, because you're going to wind up losing sooner or later.
Who wants to stay a millionaire? That is a great question. Final question. One investment for a long-term diversified portfolio, what should we all own some of?
Well, I do think we should all, there may be two different questions there. I do think we should all own some gold, because we may be wrong and the world may go to hell in a handbasket. You want to own something that's going to be worth something under the worst case scenario. But I think that if you have a really long-term perspective and want to own something that actually can appreciate in value, any of these technology names that I talked about before, I think will make you money in the long run. So to pick one, Microsoft.
Robert Kleinschmidt from the Tocqueville Funds, thank you so much for joining us on Wealth Track.
Great to be here.
At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's action point is follow the example of Robert Kleinschmidt and make sure you have some contrarian investments in your portfolio. As Kleinschmidt and other successful long-term contrarian investors will tell you, it is among the shunned and vilified that you can frequently find the best values. Current examples of contrarian investments are U.S. Treasury securities and U.S. stocks. Individual and institutional investors have been fleeing both. Gold and gold stocks are also out of favor with the herd. Kleinschmidt recommends selectively owning both, and as we just heard, is finding many opportunities in stocks. I hope you can join us next week as we launch our 8th year of Wealth Track. Hard to believe it's been that long. In the first of a 2-part series, we are going to explore the growing global emphasis on what's now being called impact investing. That is making investments based on your values, and it's gone far beyond what used to be called socially responsible investing. So what is it? How do you do it? And how profitable is it? 2 impact investing experts will have the answers. And that concludes this edition of Wealth Track. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Tocqueville Asset Management, contrarian investors combining independent thought with in-depth research.